Walt Disney Company CEO Bob Iger recently sold a huge stake in Disney stock. It's something that's got the internet talking quite a bit ahead of an annual shareholder meeting and a proxy fight right now with folks like Nelson, PELTZ, and TRIAN. But today, we want to talk about the why. In this case, why would Bob Iger do this? And this is going to be probably a very different conversation than you've seen to this point. What you're about to see is a panel of financial professionals from both investing and tax backgrounds to discuss what this means. And is this something that's out of the ordinary? Stick around. It's a conversation you don't want to miss. Renegade Online. Well, folks, welcome back. Another great day here at Valiant Renegade. It's good to see everybody out there once again. And if you are like one of the many watching this video not yet subscribed, please take a moment and turn that little red subscribe button to gray. Hit that like button, hit that notification bell, share this sucker out on the social medias, and of course, please do leave a comment before you head out the door today. We have a lot to discuss. This is a story that has been making the rounds on the internet, on YouTube, and everywhere else now for the last couple of days. And it's high time that we kind of dive into this from a professional perspective, a financial perspective, a tax perspective. And we've got the panel right here today to help you understand the reality of this situation. That's what we do here, right? We put the Hollywood industry through the business and financial lens of reality. And even though that we have spent the last several years on YouTube being righteously critical of the Walt Disney Company and righteously critical of Bob Iger and his management of the Walt Disney Company, we do have to take a step back from time to time and look at things in a more sober fashion. Not everything is an angry rant, at least when it's not deserved. And this is one of those times because we want the folks out there to be armed with the right information. We want the folks out there to be educated on how this stuff works. And we've got a great panel here today. And this all started with this story of Bob Iger selling off a wealth of Disney stock in the last year. So we want to put some perspective into that. And today we have two people here. First, a CPA and a tax professional, Mexican Iron Man. How are you doing, sir?
Very well. It's tax season here at Valiant Renegade and Mexican Ironman Global, and was just doing some stock work around one of my clients that gets executive compensation. So when you called earlier today, here we go. Let's go. Let's do this.
Absolutely. And somebody who's not unfamiliar with numbers and financials, and of course investigative journalism, Mr. Jonas J. Campbell. Good to see you.
Oh, so good to be here. I was so glad when I got the call that this video was going on. And I have questions myself, and I find the best way to investigate something is to show up here and say, hey, Valiant, what's going on with this number?
Yep. And this is a great time to talk about this because, as Mike correctly pointed out, this is tax season here in the United States for those of our friends out there that may be watching in international areas. So a lot of this comes up this time of year. This is not unsurprising. So we want to talk about this from a perspective of just tax and financial planning reality and why this kind of thing happens. Because, yes, at first glance, we can look at this and say, well, Iger has sold a metric ton of Disney stock, but why? So we're going to answer the why question today. So this started, folks, with a story that landed in the last couple of days, and I think we all saw it. We've seen a lot of folks on YouTube talk about this, and that is this CEO Bob Iger slashes his Disney stake by 80%. This is from 24/7 Wall Street, talking about investors can learn things by paying attention to so-and-so and such. I get all this. The crux of the article, to skip through this, and let's talk about the nitty-gritty here, is where they showed this figure. 1 year ago, Bob Iger owned around 1 million shares. worth over $97 million. On last look, he owned less than 187,000 shares, a decline of about 844,000 shares, and the stake plunged around 80% to more than 19.2 million. The question that may be foremost in many investors' minds, Disney investors that is whether Bob Iger is preparing to pack it in and let someone else take up the reins of reviving Disney. But of course, as mentioned, insiders sell shares for a variety of reasons. Time may tell what Iger is thinking or whether he knows something that we don't. So, Jonas, Mike, first glance at this, I understand a lot of people's guttural reaction as this is a panic mode for Iger. And it may be. That's certainly a reasonable possibility given all of the machinations of the Walt Disney Company over the last couple of years. But let's talk about this from a financial and tax perspective to help folks understand. So, Mike, any initial thoughts on this as you see this?
Well, I mean, anytime you have an executive of any company publicly traded, there's a variety of reasons. One reason could be that they are on the way out the door. Another reason, which that's usually the less common reason. The two common reasons are because their executive compensation is tied in the sense that they're not getting actual cash on the W-2. They're actually getting stock that value of which may show up on their W-2 because that stock vests as part of a vesting stock option program.
The magic word is vesting, right there.
VSOPs is what they're called, VSOP, vesting stock option plans. Mm-hmm. And so what often happens is that they have these option shares that are at, say, price A, but when they vest out, they're available at, say, price B, and there's that spread. And so when those options come up on the schedule, because there's a clock going, right? Some companies go 3 years, some go 4, some go 6, some go 5. Typically, they're usually between 2 and 5 years, and they tie to the contract that the person has. So if they have an employment compensation contract for 3 years, they're probably on a 3-year vesting schedule or 4-year vesting schedule if it's 4 years. That's just what's most common. There are exceptions, but that's most common. So a lot of times what will happen then is that the stock matures in terms of that vesting schedule. Mm-hmm. Okay. And so what will then happen is it triggers a taxable event, which then leads into the third most applicable reason why stock is sold, is that stock will come into their personal portfolio through the designated broker of record. Every Fortune 500 company, well, any company that's publicly traded that has any of these plans has an independent broker assigned. That could be Fidelity, that could be any number of companies that do the.
In the case of Disney, it's likely somebody like J.P. Morgan Chase.
Yeah. Right. Yeah. And what happens then is that this vesting of the stock creates a taxable event, and so they will typically sell some stock. Now, they might sell stock that's recently vested, or more likely is what's the case is they'll probably sell some stock that they previously got that they were holding them, hopefully has some appreciation, so that after they use that money to pay the tax bill, they still got some stock sticking around. So look, there's other reasons that, there could be a life-changing event. That's the fourth and also least likely situation. A lot of times I'll see clients that are looking forward to selling their stock when it vests or previously vested stock because they want to do something major, literally renovate a house. And we know from news releases with Bob Iger in particular that he's done major renovations in the past years prior to his last departure. So there's a lot of reasons, a certain life event where you want to get your hands on the cash that may or may not have anything to do with whether or not the person plans on, say, sticking around or not. So this is very
common, right, Mike? This is very common with high-level executives because...
I'll tell you, another life-changing event is a divorce, for example. So
yes.
That's not the case here with Bob Iger, but
it's not. Yeah.
It's not the case
here. But let me ask you...
But I'm just saying, the life-changing event. Those are a couple examples. They're going to They're going to build a $5 or $10 million ranch in Montana, or remodel their house, buy a yacht, whatever.
Let's take a very simplistic example for the folks out there to understand. Is that here's the deal, right? If you earn a paycheck via W-2, you get paid in cash For the most people out there watching, they're paid in cash, right? They get a direct deposit in their bank account. They get taxes withheld. They pay taxes on that money. If those folks then go to, say, a game show, for example, right? And they win a car and a vacation and all this other stuff, and the value of your prizes are $25,000. Well, guess what? They're getting those $25,000 of prizes, and what do they get at the end of the year, Mike?
Oh, they get a nice little tax document that
they get a 1099.
Yeah,
for winnings. And what do they have to do with those $25,000 that wasn't in cash, but it was in a car and a vacation?
Right. No, they got to pay. They got to pay taxes on it, and typically they'll be when they get the tax document, they'll either get the tax document, and might be withholding if there's cash involved, but if there's not, they're still going to get for that value received. They're still going to get the value of the $50,000 worth of winning.
It's imputed income, right?
Yeah.
It's not cash, but it's
same thing happens when you gamble. A lot of people play slot machines.
Casinos.
You get a W2G for that, a gambling W2 for that.
Yeah. Now, if I can push back on you guys a little bit,
go ahead.
Here. I want to point out some questions I have, because the circumstances seem a little bit different with Bob Iger in particular. I've got the 2022 proxy statement. Yep. This came out in January 1st of 2022. Mm-hmm. So this is what's being referenced here. This initial amount here from Bob Iger, 1 million shares. Within 60 days of that, he's going to get an additional 2 million and some change in shares
as part of his compensation contract.
Right, because he has at-risk compensation, meaning that he gets paid in shares. He does get sizable amounts in bonuses, but that's neither here nor there for this conversation. So and then we fast forward to 1 year later, and he's got 186,874 shares. Again, hanging over here, he's got these 200 million. Beside the fact that 24/7 Wall Street or whatever that publication was a year behind, the major action here happened in that 1 year period. Mm-hmm. Do you think that Bob Iger coming back in let's see, he actually came back in 2023? Maybe I'm
late
I'm
22. Yeah,
late 22. Okay. Yeah. When do you think he sold those shares? Do you think that he did it? Say when Nelson PELTZ was there challenging and that stock price was on the rise, and he saw a moment when the stock was headed in the right direction and decided to cash out. Then if he's going to, if he's got to eat, if he's got to live off of this money and he's got to pay his bills with this money, do you think that he was taking advantage of the situation of the proxy fight and maybe seeing an elevated stock price here and saying, you know what, this is my moment. This is when I'm going to be able to afford that extra Barbie dream house for the grandkids?
I think Bob Iger was taking advantage, like any CEO, of the stock price when it went up, regardless of the reason. So let me throw some color onto that, because everything you just said is completely within the realm of reason. But if we go back and we look historically, Bob Iger's, and I'm going to show you folks some other examples in just a moment. I'm going to show you how this works. So Bob Iger's, a significant portion, 50+% of his annual compensation is in stock. And a lot of times executives, when they receive stock as part of their compensation, more often than not have some type of mandated holding period, usually up to a year, or sometimes more than a year. Depends on, as Mike said earlier, the key word is vesting, when they're vested in that stock. So in this case, let's look here. Bob Iger has this many shares, 186,000. He was due another 1.9 million within 60 days of this annual report back in 23. I want you to, everybody, put your thinking caps on for a second and realize that Bob Iger has been the CEO of the Walt Disney Company since 2005, 20 years. This has been going on every year for 20 years. So if Bob Iger's compensation, like many CEOs, is largely tied to performance-based metrics with stock awards, as is extraordinarily common with major Fortune 500 companies, S&P 500 companies. A lot of these CEOs will liquidate significant portions of the stock awards they get because, as in the case of Bob Iger, especially if you're living in California, where you have the worst taxes in the world, virtually, he's in a 37% federal tax bracket. So if he gets $20 to $30 million of stock every year, right, he's not getting cash. He's getting $20 to $30 million in stock. The IRS, the tax man, still comes knocking at the door. How do you pay those taxes? You can't pay the IRS in shares of Disney. You typically have to liquidate to satisfy the tax bills, not only for the federal government, but for the state of California. And, Mike, if I'm not mistaken, does not the city and county of Los Angeles have their own income tax system?
Well, the city and county, hold on, the state does, and the state has capital gains tax, and the feds have capital gains tax on stock sales. But I guess what you're getting at is that if there's a taxable event at the county level, like property tax or something else is due, there is the possibility that there are city and county taxes that kick in for other things going on in the person's individual tax plan.
Right.
And
I mean, for a guy like Iger, if you're getting, let's say Iger's total compensation in the past year was 30 to 40 million, but 25 million of that was Disney stock, or 20 million of that was Disney stock. That's coming down as a reported income for him. You still got to pay taxes on it one way or the other. And a lot of these guys,
state and federal.
Yeah, state and federal. And that's the point.
And by the way, in the state of California, California is one of the states that does not have a separate lower capital gains rate. Capital gains in California is income tax. It's not like, it's not
like the federal government where you have a 15 and 20% capital gains rate.
And then your personal income tax could be higher. In the state of California, your capital gains is your income.
Here's the thing. If this was new for Bob Iger or any other CEO, and again, we've got other examples coming up. People like Jamie Dimon of J.P. Morgan Chase, Mark Zuckerberg of Facebook, the Walton family, as in Walmart. Okay, this has been going on for many of these folks for years. If this was new for Bob Iger, imagine all of the stock, the Disney stock he's been awarded in the past 20 years just since he's been CEO. Forget the 10 years or so before that when he was still a senior executive. He would have been getting stock awards. Bob Iger would have had 10 times, 20 times that number of shares in the
right, because Nelson Peltz, and by the way, to bring up this guy Nelson Peltz, who is of course here in every conversation about the Walt Disney Company right now. There was a story that went around about Nelson Peltz cashing out a minor amount of shares.
That's exactly
as well. So in some ways, I do think it's fair that this conversation turns around, because if it's no big deal for Peltz, it's no big deal for Iger as well. So this is being fair.
Yes.
Here, I do question the idea of a guy like Iger, if he truly believes in the Walt Disney Company, to only keep such a minimal amount, just $15 million worth of shares here. This bugs me a little bit, and it is a vulnerability point for a man who is so laser focused on image issues to have such a small amount of stock here.
I agree. So, Jonas, let me throw this in. I want to get y'all's thoughts on this. This is an article that I addressed a couple of years ago on YouTube because I had a lot of questions when this came out. Bob Iger, this is June of 2021, 3 years ago almost, sells shares worth nearly $100 million. Now, this is when we were covering Bob Iger's imminent exit from the Walt Disney Company. This is after he left as co-CEO. This is during the period when Bob Chapek had just been less than 6 months at this point, 5 months and 4 days, in full control of Disney. And Bob Iger dumped nearly every Disney share he had. Okay? And people were asking questions. And I said the same thing. The man's now retired, or he's entering retirement. This is what happens with a lot of CEOs. He dumped a bunch of shares because He doesn't want to have 90% of his investment portfolio in one company. Nobody should, even if you were running it. That's just good, sound financial advice, okay? He needed something. Now, look, at the time, also remember, if you have 90% of your portfolio in one stock like Disney, what was the dividend, the income that Disney was paying in 2021 on those shares?
Mike, you would know better than anybody else.
Crap.
Zero. It was zero. I mentioned in a previous video, you look at a guy like Ike Perlmutter that has $3 billion worth or whatever the hell it is of Disney shares. Back before Disney canceled the dividend with the pandemic issue, when everything went into lockdown and a lot of companies canceled dividends, Ike Perlmutter was getting somewhere around $50 million a year in cash dividends on his Disney stock. Well, if you're Bob Iger and you're relying on a dividend to fund your retirement income or whatever the case, and all of a sudden the company's not paying anymore, apart from wanting to diversify your portfolio, now you have no income from it, right? Forget the fact that he was there and just go into a pure mathematical perspective. It's probably sound advice that he would have diversified. So my point is that Bob Iger, and like many CEOs, have been doing this since forever and a day.
Right.
And it's not anything particularly new. But, of course, there is the issue of, well, Disney stock price just popped up to $110 a share. It's a good time for him to bail out, considering how low it's been for how long it is. I know it looks bad coming up to a proxy fight, and I'm not trying to say that none of that factored into Bob Iger's decision, but I want folks out there watching this to be educated and understand that there are far more and far more common mitigating factors as to why this would have taken place.
Mm-hmm. Now, there's only one more thing I'll point out here. June 4th of 2021, if he sold, let's say he sold on that date, he sold at one of the best points to sell Disney stock.
Yes,
over the last 10 years.
$174 a share is what he got.
Which is amazing. And of course, you can't get that kind of money on Disney stock anymore.
He would have been a fool not to sell those shares as soon as they were vested, and as soon as his contract would have allowed him. Because again, as I said earlier, a lot of these contracts where executives get awarded stock as part of their compensation, their at-risk compensation, they typically come with a mandated holding period that is more often than not 1 full year. So as soon as those shares become available to sell, even after they're vested, a lot of times they'll pop them out, short of the stock price being in the toilet at the time. Then there may be some, but I mean, if it's $174 a share, that's why he liquidated it. It was a wise move from a purely mathematical financial perspective, and he would have been advised to do so. If I was Bob Iger's financial advisor, I would have said, Bob, I hate what you're doing at Disney, and I think the company's in a dumpster fire, but as your professional financial advisor, this is probably a good time to liquidate those shares because it's never been higher, and it's a bird in the hand situation. And it's the same thing for other companies.
And of course, Bob Iger should not take financial advice from this channel.
No, never. Nobody should.
To anyone.
But this is my point. The great cash out. This is just from yesterday on Fortune magazine. This was all over the internet. And this is why the Bob Iger story kind of flew over my head, because as somebody who's been a stockbroker for 20 years, it's like, this is like going to the bathroom. This is normal stuff. The great cash out. Jeff Bezos, Leon Black, Jamie Dimon. Jamie Dimon is the CEO of JP Morgan Chase, the Walton family of Walmart. I mean, look, I want to draw some distinctions here, however, and this is why there's differences. If you're Jamie Dimon of JP Morgan Chase and you sell shares, if you're Bob Iger of Disney and you sell shares, you didn't found the company. The shares that you have been awarded to you as part of your compensation over your tenure as an executive. Mark Zuckerberg, Jeff Bezos, where does the bulk of their shares come from? Mike, Jonas?
Well, they come from the treasury of the company as part of the VSOP.
They founded the companies.
Yeah, they're founders. They're
right.
They're usually Class A shares, actually.
Right. They're not just hired guns like CEOs to run the company that were awarded shares. Their shares are in their possession because they founded these companies and have grown it. It's a very different dynamic, but it goes to show that this is relatively common practice. And people are like, why is Zuckerberg selling, this? Why is Jamie Dimon selling that? Why are the Waltons selling this? And it's like, taxes, income, diversification, liquidation of shares. Walmart, I talked about this briefly, I think a little bit on Twitter the other day. People were asking about this, or I mentioned this on the Sunday show. Amazon was just placed on the Dow Jones Industrial 30. Why? They kicked off Walgreens. They brought in Amazon. And a lot of it had to also do with the fact that Walmart, speaking of the Waltons in this article, they just liquidated a bunch of shares. You know why? Because Walmart did a 3-for-1 split. And the Dow Jones, unlike the S&P 500, is based on stock price, not market cap. So when Walmart shattered their shares into thirds, it dropped the price of Walmart by 2/3. And it created an issue with the Dow. So by booting out Walgreens and with Walmart dropping 2/3 of their share price by doing a 3-for-1 split, they had to bring in Amazon to make up the difference to represent more of the retail space. That's what happened. So things like that affect how these CEOs and these executives behave with this. But again, going back to the beginning of this, the most common factor, folks, is the fact that guys like Bob Iger get mostly paid in Disney shares. They have to pay taxes and for their 2 or 3 yachts like Bob Iger has and all of his California parties with cash. You can't pay for it in Disney stock. And if Bob Iger had never done this before, and if this was something new, Bob Iger wouldn't have sold off 1 million or 2 million or 3 million shares. He'd have been selling off 30 or 40 million shares. He'd have been selling off 10 times that much. But he's done that over the course of time as common behavior each and every year. So I know it's a bad look from that perspective. Like, we're coming up to a proxy fight, and we're coming up to a board meeting, an annual stockholder meeting, but I don't see this as anything out of the ordinary. But look, you guys chime in and feel free to tell me that I'm crazy.
Well, there's something that I just want to, Jonas, before you go, I just want to say this, is that one of the things that happens with these CEO types is that if the stock that they're sitting on vests and it's not issuing dividends, they literally will redeploy the value of that stock in their portfolio to other things that might be purely as a diversification strategy. And that might be like, some people might have the reaction like, so Bob isn't sticking, by his guns, by what he's going. Well, you know what? When you're an executive of a company, and God knows I don't want to defend Bob Iger, and I'll tell you why in a second, is that
I don't either, but
sometimes you put on your hat as a CEO, other times you put on your hat as like, well, I'm a guy working at this company and it is what it is, and I got to diversify my my strategy, especially my financial advisors telling you. Now, here's the one funny caveat. If he sold at 172 to 174, guess who's a panel guest on this live stream that bought at 172 and 174?
Right?
Oh my!
So it's very well possible that I actually bought some of Bob Iger's stock.
Well, that's why I was talking about earlier, like with Ike Perlmutter. Think about this guy.
Use it to vote against him.
He acquired his Disney shares through the sale of Marvel Studios, or through the whole Marvel Entertainment enterprise. $4 billion. Much of that was in Disney stock. Just like when George Lucas sold Star Wars and Lucasfilm to Disney. There was a report. There was 40 million shares reportedly that was handed over, minted newly at the Disney stock treasury, over to George Lucas. Now, we don't know how many George still owns, but rumor has it it's less than what he started with. Ike Perlmutter obviously still has all the stuff he started with when Disney paid him for Marvel. And when Ike Perlmutter, why was he still at Disney? Why couldn't Disney for the longest time get rid of him? Well, not only was he the biggest individual shareholder besides George Lucas for years, they were paying him nearly $50 million a year in cash dividends as a stockholder for those shares. What do you think Ike Perlmutter felt like in 2020 and 2021 when all of a sudden his $50 million a year in Disney dividends went up in smoke? I mean, think about this. Even now that it's back, I mean, it's not back to what it was. Hopefully one day it'll get there. But I mean, that's a big swing. Mm-hmm. So my point is that Mike is right, is that when you get to that moment and you need additional income, you've got to pay taxes. There's a lot of other things that go into this. And executives across the board, not just at Disney, but probably most of the Fortune 500 companies, the stock awards that come to these executives often get liquidated as soon as they're vested, and liquidation becomes a possibility after their holding period expires because they need to do other things with that cash. They need the cash, not the stock. That's why it's a performance incentive. It's like getting paid out in Bitcoin. Well, that's great. But, it's like, I'm still running this company. They're still going to hold stock. They still have a vested interest in the performance of the company because they're going to continue to get awarded stock each and every year. And they want the value of that stock to get bigger and bigger. So when they get those awards based on numbers of shares, that those shares are worth more when they sell them. But they still got to pay taxes on them. So if you're getting $10 million of cash compensation and $20 to $30 million in stock, and the IRS is taxing you on $40 million of income, well, basically your whole $10 million in cash is going to be spent paying off the IRS in this case, the state of California.
In this case, the state of California, absolutely.
Yeah.
Well,
because Florida doesn't have personal income tax for people.
That would have been great for a bunch of Imagineers if
right?
been wildly unpopular.
When Chapek was trying to move them out there and they didn't want to go because Florida was a big poo-poo head red state. Oh, so,
yeah. I understand everything you're saying, Valiant, and I don't disagree with you. I think you have the more correct and the more experienced take here. I just want to say that of the 5,993,429 shares that he is received since he or held since he came back to the Walt Disney Company, not counting the stuff that's about to vest,
right?
He only has 205,000. So 96% of those shares he has sold in order to
now it's a completely valid. Now from the outside coming in, see, I think what Valiant and I are trying to do is come from the tax and investment advisor.
That's inside.
It. We're trying to come from inside out, but from the outside optical. Hey, look. As someone who watches this stuff, you think I'm happy that, well, first of all, I can tell you on the outside in, I'm not happy that I bought Bob's stock at 172, 174. But but on the outside, do we want to see our CEO that's in charge of stewarding this company selling any stock? No, we want to see him hold it. We want to see him hold it for a long time. We want to see him pay dividends. And we want him, as retail investors, to go along with the ride like we're going to go along for the ride.
Well,
right.
as well as the board.
And more importantly, as Jonas talks about from a board governance from a board governance viewpoint, we obviously want the people that are on the board of directors to hold a significant amount of stock where they've got as much skin in the game as possible so that they hopefully in a capitalist marketplace are going to make the best decisions possible versus what we see Bob doing, which is take his chips off the table and yet exercise literally demonic control over that boardroom.
Mike, you brought up an excellent point there, and I want to touch on that. I didn't even think about that, but I think this is something the audience needs to also consider, is that, yes, what you just said about the board and the executives holding a significant amount of stock. I agree with you. They should be very vested in this. Here's the deal, right? If they're awarded stock through executive compensation and liquidation is necessary to satisfy taxes, which is usually one of the most primary driving factors for those liquidations, because the IRS, like I said, the bill comes due, whether you got paid in cash, Bitcoin, stock, or a car, it doesn't matter. The taxes come due. That doesn't then prevent somebody like Bob Iger with his immense wealth to turn around and go back and personally buy more Disney stock on his own, nor any of the other executives with after-tax money, right? They can still do that. They can still self-vest in the company. And that's the difference. And that's an excellent point. So when you see, and again, it's not common for most companies or most CEOs, but it can happen. It can happen.
Yep.
So, I mean, I think it's a great point made by Nelson Peltz. He put a video out with TRIAN and Restore the Magic. I think just today they released a new short video on their Twitter page.
Ooh.
Where Nelson said, and I'm paraphrasing, but not by much. It's almost a direct quote, where Peltz said that, look, these people on the Disney board, these are wealthy people. They could buy Disney shares. They could own more Disney shares. They don't. I mean, effectively by choice, right? So why? Why have they not? If they're on the board of this company, why have they not chosen to personally invest in the company that they're managing? I think that's a very fair question.
Can I just point out one that is extra hilarious to me on the 2024, the most recent proxy statement? Derek Rice down here at the bottom with a single share of Disney stock.
Oh, come on. He sold one stock on his Robinhood Securities account. What a joke.
Beautiful.
He probably bought Palantir or something.
Yeah.
Yeah, I'll point out, I think that Chapek has more shares than these people. So,
yeah, and Chapek may still be sitting on some of those things. I mean, and look, Chapek would have been doing the same thing, to be totally fair, right? If he had a significant portion, more than half of his compensation based on the awarding of shares of stock, again, like most S&P 500 company, publicly traded company CEOs, he would have also had to, from a financial and tax perspective, had to liquidate those shares each and every year to satisfy taxes due and to satisfy other necessities at that level of lifestyle. That's kind of normal in the course of events. But, this is where we are. And I felt like, we needed to have this discussion because we love all our friends out there on YouTube, but we understand that, a lot of them aren't experienced in the financial and tax side of things. And I wanted to bring a little perspective. And like I said at the beginning, everybody out there watching knows I've been one of the most harsh critics of Disney's behavior as a company for years. But, and the people out there can come to their own conclusions. We're just here to add a little bit different flavor, a different perspective to this debate, just to, again, help people try to understand what may be going on apart from what everybody else is talking about. And I just think it's worthy of conversation. But I want to thank you guys for being here because I think this was great. And I really hope this helps a lot of people out there understand from that perspective, because we want to be able to, Disney deserves to be lanced for a lot of the things that they do wrong. But we also have to be fair from the other side and bring in a perspective that is reasoned when it comes to things that may not be immediately what they seem, if that sounds fair to you guys.
No, it does. And I just want to point out that while we are not going to give Bob Iger a hard time about his lack of shares in the company that he is the most vociferous advocate for, there is a video coming out on my channel at 11 a.m. on Thursday that points out the $12.5 billion that he just officially lost on the Disney Reliance Media deal.
Yes. That was a boondoggle for them from the time of the Fox purchase.
Wait, did you report on that
sale
a couple weeks ago, Jonas?
I did. It was only $12 billion at the time. I was corrected that.
Did they finalize that deal? I missed the news.
It's
more or less. Yeah.
Oh, hashtag Jonas was right then. Hashtag.
Yeah. So I said 12. I backed it off to 10 because somebody pointed out that it was just percentages. Those percentages went lower, and now we're at 12.5. If you want the details, go check out the video tomorrow. Or Thursday. This is not coming out on Wednesday.
Well, it's already almost. Yeah, okay. All right. Well, thanks for Valiant. Thanks so much for having us. And this has been great.
I'm so glad you guys are here, folks. Make sure you check out Not a YouTuber, Mexican Iron Man. over here on his channel. And make sure you check out kind of a YouTuber, Jonas J. Campbell down there on his channel, Everything Woke. And, of course, That Park Place. We want to thank everybody for being out there. And make sure you check That Park Place's live show and the live show with WDW Pro Tuesdays and Thursdays. Midnight's Edge time, guys. Noon Eastern on those days, Monday through Friday. Thanks for being here, and we look forward to your comments. Share your thoughts. Do you think we're right? Do you think we're wrong? Love to hear from everybody. But until next time, take care. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.